Hey, so this is our last adjustments lesson, lesson 14. And in this lesson, we're going to talk about amortization, sometimes called depreciation. And what that is, if we switch to our more detailed note, amortization is our last allocation. And so in other words, where we arbitrarily decide that we're going to take asset value and turn it into an expense. And when you do it, when it's called amortization, what you're doing it with is long-term fixed assets. And you're doing it, as it says, you're taking value away from that fixed asset and turning it into an expense to reflect the fact that those long-term assets wear out over time as you use them. Take a look at this illustration, this example. Imagine if there was no such thing as amortization. Here's our little balance sheet, here's our equipment, and here's an amortization account where we have none of it. So in other words, it's a universe without amortization. So we bought this machine for $40,000 and we used it for 4 years. Right? And on the income statement, we have our net income before any amortization, and we show no amortization expense, no loss on the asset, no wear and tear. And then in year 5, when it breaks, we all of a sudden we have no asset value. The value is vaporized. It's all wiped out in a single expense in that year. And take a look what happens to our profit. We have this constant profit going along, and then all of a sudden in the year when it breaks, we show this huge cost, destroys our profit. Does that make sense? Remember the purpose of accounting, to produce useful information for decision making. Does this information convey what actually happened over those years? Well, no. The asset wore out slowly as you used it over 4 years. So why would you ever present it like this? You shouldn't, right? And that's why amortization exists. There are 2 methods. They are shown right here. To do amortization, there's the straight line method and the declining balance method. For every fixed asset, except land, as it says right here, because essentially it's for any asset any long-term asset that has a definite life. In other words, you know how long it will live, or you can reasonably estimate. So land, you can't. It may last forever. It will certainly exceed probably the length of the business's existence. Certainly our existence. So you don't amortize land, but everything else you will amortize. And that means there are 3 accounts involved. There will be the long-term asset account, like equipment or machinery, not land. And for each of those accounts, there will be a contra fixed asset account, and we know what contra accounts are by now, or we should, right? They're married to the asset account. So each asset account will have an accumulated amortization account where you are going to, as it says, accumulate all of the amortization as the years go by. And then you're going to have an amortization expense account where all of the amortization each year gets plopped to show the asset values wearing out. There's one other thing you should understand about amortization. And for that, we need to do a quick little note. With amortization, as with essentially everything in accounting, you're concerned about 3 things. And I've already mentioned these in a previous lesson, right? They're the acquisition of the item. And then if you're holding it for several years, it's the adjusting required as time goes on. So how do you adjust it? And then at the end, there's disposal. How do you actually get it off your books when you're done with it or it's broken or whatever? And there's a couple things you need to know. And this one, remember we talked about the acquisition. When you acquire an asset, you have to include all costs associated with getting it ready and acquiring it and getting it ready for its intended use, right? And then adjusting, we've just learned that assets, long-term assets with definite lives, have to be amortized each accounting period to show that your equity in that asset disappearing as you use up the asset. And make sure you make a note of this too, that amortization is no attempt, or even what eventually results is called book value. We're going to talk more about book value when we talk about amortization, but these things don't equal, they're in no way an attempt to come up with the market value. So in other words, what is the resale value of this? That is not the purpose. It's merely to make an allocation, an effort to show that asset's value wearing out as you use it. And then the last thing you have to worry about with assets is that when you dispose of it, you have a couple things to make sure you've taken care of. One, amortization. I'm just going to abbreviate this. Amortization has to be up to date. So in other words, if you hadn't done it yet this year, and you sell it in June, that's 6 months into the year, you have to do 6 months worth of amortization before you can dispose of the asset. So amortization has to be up to date. And then next, you have to realize that you may have a capital gain or loss on disposal because of this, because it's in no way are you trying to reflect the market value. When you do go to get rid of an asset, the market value is almost never the book value. So the question is, do you have a capital gain? In brackets, I'll put loss. And you find that out simply by taking proceeds, in other words, what you sold it for, and you subtract the book value. And if your proceeds are larger than the book value, you've got a capital gain. And if they're not, if the book value was more than you sold it for, then you would have a capital loss. And then the last thing you do is you have to actually get rid of, or erase, I guess I could say, you have to erase all the accounts associated with the asset. So in other words, if you sold a piece of equipment, you have to get rid of the expense account. You'd have to get rid of the equipment account, and you'd have to get rid of the amortization, the accumulated amortization account, the contra asset account that's married to that equipment account. Right? So all related accounts to the asset have to go away. That's sort of the last consideration with amortization. So, on that note, let's try the next exercise, which is exercise 26. Before we can start the exercise, we have to make sure we remember these formulas. There are two types of amortization formulas. The first is for the straight line method, and the structure of the adjustment is the same. It'll just be the dollar amount of the expense that changes. So the straight line method uses this formula, and it's really important to understand that these formulas give you the amortization expense for 1 year. If you need it for a month, then you have to divide by 12, for example, right? So the amortization expense for straight line is the value to be amortized, which is the original cost, so the original purchase price, divided by any salvage or scrap value that simply won't wear out. So like if a machine's made of metal, then that metal may have value forever. So you don't want to amortize that because that value will remain. So I ask this question a lot, why you subtract the salvage value in this numerator. And the answer is this numerator represents the value to be amortized, the value that will wear out. So you subtract away what will not be wearing out because you don't want to expense that. And this value to be amortized in the numerator, you divide by the useful life in years. And so you spread it evenly over all the years that you think it will last. So clearly you're not a fortune teller. So this is why it doesn't try to relate to market value. It's just an estimate. The next method is called declining balance. This is an example, which you can look at later. But the next method is declining balance. And so what you do, here's the formula right here. The amortization expense, again, for 1 year is found by taking the cost or the book value, which is what this is in brackets, and multiplying it by the amortization rate, which are usually given in a question. So purchase price minus all the amortization to date that has been written off leaves you with the value to be amortized, right? The book value, it's called. So in the very first day you buy it, this book value is the entire purchase price, the original cost. But years later, that book value will have fallen as you have written off some of its value, right? And your accumulated amortization gets bigger and bigger. So you need to remember those two formulas. Let's try the exercise. Now, you start with amortization schedules. Now, I'm not going to do all of these. I'm going to do D because D is what we need to do the journal entries on this tab. It just has you journalize for D, right? So once you know how to do one, the rest are the same. And this page actually does tell you how you're doing. It self-marks. So I'm going to let you fill that in on your own. I'm just going to do one example. So up here you have all the assets, and here it wants you to come up with the yearly amortization rate as though you were doing straight line for all of them. And then down below, notice the letters. We have A, B, C here and A, B, C, D. You're going to do the assets again using declining balance. So straight line method. So I'm going to do D. To do this, we need the straight line formula. And that's simply purchase price minus any salvage or scrap value. So purchase price, I'm going to put it in brackets. purchase price minus scrap value gives us the value that will actually wear out, the value to be amortized, $11,940. We're going to divide that by the cell that contains our estimate of its useful life, which is 3 years. And we get the annual amortization expense, which is $3,980. And it's the same process every time. So once you know the formula, it's very easy to do. So we can actually copy it everywhere. And there would be the annual amortization amount for each of the years. Right? Just remember that in these cells, there's more decimal places. So if you're amortizing this for 11 years, you're going to be off by a couple of cents if you don't round that to 18 cents, right? And drop everything else. So really what I should have done is go round this calculation for straight line to 2 decimal places and then copy it up, right? Because now I won't be off 20 years of amortization later. I won't be off by a few cents on my total. Okay, so let's do D for declining balance. So it's the same asset, but what if we amortize it using declining balance? Now for declining, so this is the annual amortization rate all the time, which is why it's called straight line, because if you graphed it, it would be a straight line of amortization value. But declining balance is different, and I'll show you how. So we still need this number. So we go down here to D. The book value at the start of the year when we buy this asset is what it cost, $12,400. This is where it becomes really important to understand the concept of book value with amortization. And it comes up in other places, but book value is essentially the cost of an item, so original historical cost, minus any adjustments. So any contra asset values or any other deductions. So for an asset, so let's say for a fixed asset, a book value would be always the cost minus any accumulated amortization to date. All of it, not just this year's, but all amortization for this asset. When you take that away from the original cost, that leaves you with the book value. And then again, just so that we're clear, a capital gain, and this is true in not just accounting, right, but investments too, right? A capital gain or loss on a stock portfolio is calculated the same way. You would take the proceeds from selling the security or the asset in this case, and you would subtract its book value, not its original cost, but what it's worth to you now. So the book value, right? So a very important concept, both of these, both how to calculate a capital gain and what book value is important beyond the realm of just accounting. So let's try some amortization with that in mind. So if this is our original book value, because we have no amortization at the start of the year, then our expense is going to be, if you follow the formula for declining balance, it's the book value times the rate, which are usually given in grade 11 in a question. So that would be $2,480 a year. The book value at the end of that year is the original cost minus what's been amortized, which is $99.20. Now remember, everything on the screen, all of these amortization amounts are for a year, and so is this. This would be this would be the first year's amortization. If you want to know what it is for a month, you'd have to take this and divide it by 12, right? Don't forget about rounding. You'd go round, and you'd take this, divided by 12 to 2 decimal places. That would be your answer, and then you know it's properly rounded. So guess what? If this is our ending book value, it's also equals this is our starting book value for the next year. So our amortization expense for the second year is going to be this times 20% again, which means our ending book value can be copied as a formula down again. It's going to be starting minus what we wrote off as amortization expense. That's our ending book value, and so on and so on. So this is what we start the next year with, because it's what we ended year 2 with. And these copy down as well, and so on and so on. And that's why it's called declining balance. The balance in other words, the book value continues to decline. You hit it with the same rate, but the balance in the book value balance is declining, and so the expense is declining. This results in something interesting. If you graph it, an axis time, and this is your amortization expense. If you graph straight line amortization over a number of years for an asset, straight line, right? So this is the expense. Every year the expense is the same. Whereas declining balance often will start higher and the expense amount gets less and less and less and less and less. So they have very different sort of results. And you should, if your goal is to provide useful information for decision making, then you should pick the amortization method that best reflects how an asset actually wears out. So for instance, right here, this one, if say like a vehicle, often cars will lose a lot of their value early in their life, right? So you should probably pick declining balance for cars or vehicles, delivery vehicles, where if you use an asset about the same amount all the time and it wears out kind of evenly over its life, you should probably pick straight line. So let's use this information to journalize. We'll start with straight line. So in the journal, it says, make the journal entries necessary to record the acquisition, adjustment, and disposal of asset D using the straight line method. And let's say the asset is sold for $1,000 at the end of year 3. All right then. So we're going to assume that we're acquiring at the beginning of the year to make life easy. So January 1st, we buy this asset. This is asset D on this schedule, right? So we're going to buy this asset. So it's $12,400 and we'll ignore sales taxes. Add a heck with it, we'll put them in. So we're going to go equipment. Actually, we don't have an account for that for taxes, so never mind. So we're going to buy equipment. It's going to be $12,400, and we're going to credit cash $12,400. And take a look over here. On the January 1st, we have $12,400 of equipment, no amortization accumulated, which means the book value of that asset is what we just paid for it. Right? Makes sense? About a year later, December 31st, very end of the year, we need to adjust. So this asset has worn out, so we're going to have amortization expense. And we don't, this is one of the first mistakes student will make, we don't credit equipment, right? The historical cost gap says that stays at $12,400. What we credit is the accumulated amortization associated with equipment. And that amount is right here. There's our annual amount, $39.80. So I'm just going to put it just like that. And so now you can see our little balance sheet snippet at the end of the year, December 31st, equipment is still shown as $12,400 and always will be. But we show accumulated amortization of 1 year's worth, and the net book value, this minus this, is $8,420. So we are showing our asset value wearing out. And again, that applies also to when we're doing financial analysis. We wouldn't be using any ratio that uses total asset value or fixed asset value isn't going to use this value. It's going to use the book value. And so those values will be less in your calculations to reflect wear and tear on asset value and the erosion of wealth. Right? So the next year, this repeats. On December 31st of 2019, we will have another, because a straight line, it's the same every year. We'll have another amortization expense of $39.80, credit accumulated amortization $39.80. Understand that each year, this is the amount of the expense that's shown each time, but the accumulated will continue to build because it's a contra asset. So now at the end of the second year, equipment is still $12,400, but we're subtracting now twice as much. So $79.60 in total accumulated amortization, which leaves a book value of just $4,440. So here's the tricky part. I'm going to show you 2 ways to do this. Your assignments are going to do the harder way, but I'm going to show you the more logical way first. So then the final year when it's disposed of in 2020, at the end of 2020, here's what it's going to look like. You need to make sure, remember the considerations, you need to make sure amortization is up to date. That's the first thing you have to do. So there's the third year of amortization. So on December 31st, just before we dispose of the asset, equipment is still shown at $12,400, but our accumulated amortization is now fully the amount that we wanted to amortize. Notice this book value is only $460. That $460 was also, if you go back, it was also the scrap value, the value that we don't want to wear out. So we've exhausted this, and if we're going to sell it now for $1,000. So the actual disposal looks like this. We would have cash of $1,000 because that's what we're going to get. And now you have to get rid of all the accounts associated with the asset. So one of the first ones is accumulated amortization, right? It's got a credit balance. If we look, there's our 3 credits to accumulate the amortization. This is what's in the account. So we need to take out $11,940, and this will go away at the minute we debit it. Gone. Guess what else we don't have? We don't have this. So we're selling the equipment, so all accounts related to the equipment or asset have to go away. So we have to credit $12,400, the original historical cost gap value, out of the account to make it 0. And now this piece of equipment is completely gone from our books. But this entry doesn't balance. And I'll prove it to you. We'll sum this up and we'll sum this up. They are not the same number. The difference is a capital gain or a capital loss. And here's why. The question tells you sell it for $1,000. Well, its book value, if you recall, was $460, right? Before we did this. I'll delete this. Right? Before we did this entry to dispose, remember it was $460 of book value. Well, if we're getting $1,000, that means we're making a capital gain. So it will be a gain on disposal of $460. Now, gains are like revenue, and revenues are credits. So if you're missing credits, it's a gain. And if you're missing debits in this journal entry of disposal, it'll be a loss, like expenses are debits, right? So a loss on disposal will be debits. Now, that was in 2 steps, which is great for learning. You can see, I'm even gonna highlight this like this. Make it a nice color. How about green? Wonderful. So this was 2 steps, but you really would do it in just 1 as a pro accountant. Take a look how or why. Here you have, I'll highlight in red, you've got accumulated amortization on the equipment, and you're crediting it for that last amount of amortization for year 3, the final year. Here you've got accumulated amortization again, except it's a debit. Well, these are the same account, right? Credit, 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 debit. Well, if you didn't accumulate this, you wouldn't have to debit it out. So these actually can consolidate, and you can have 1 entry. So you have to, at first, I would suggest you do it like this, at least in your head or on a scrap sheet of paper. Do it in 2 steps. Get your amortization for the final amortization, get it up to date to the date of disposal, get that done and out of the way. Then do your disposal journal entry until you get really, smooth with this. Otherwise, it can be kind of tricky. So here's how you would do it in 1 step. You will still get cash. It'll still be $1,000. You will still have to record that last year of amortization. You still have to get amortization up to date. And it's still going to be $39.80 for a full year. If it's half a year, then you have to take half the amortization amount. You will still have. So I'm going to erase this so that we can see what's in the account. The accumulated amortization at this point is $79.60. So we still have to get rid of the accumulated amortization, right? At this point, you've got 2 entries because we're not accumulating this 3rd one. We're just expensing it right away. So it's not going into the account. So we only have $79.60 to take out of that account. $960, $79.60. Now it's 0. There we go. The last bit will still be a capital gain or a loss, so you still have to get rid of the equipment, though, don't forget. So $12,400, right? So our balance sheet is gone. There's nothing relating to the equipment anymore. That's right. We still have a capital gain to recognize, and we do the same process. You can total up your debits like this, and you can total up your credits, and you can see, notice the result is the same. It doesn't change the result. It just consolidates it in 1 journal entry instead of 2. The result's the same. You're missing credits. You're missing 460 of them. That means you had a gain on disposal because credits are like revenue, right? And I can't add, apparently. 460 is what it's worth, so 540, my mistake, is the gain. So the second part at the very bottom is doing exactly the same thing for asset D, except assuming you use the declining balance method. So you're going to use this table. So in other words, the amortization expense will not be $39.80 every year. It'll be these values, and it will change each year. So the structure of all the journal entries will be the same. It will just be the amortization that's going to change. Everything else is the same process all the time.